Everyone wants income. Everyone wants cash flow. But the question is, at what cost? That's where covered call ETFs like JEPI, QYLD, and the newer YieldMax funds come in. They all promise steady income, big yields, and the idea that you can live off your portfolio. But here's the real question. Which of these actually works, and which is just Wall Street's latest gimmick? Today we're going to break it down, head-to-head, no fluff. JEPI versus QYLD versus YieldMax. Let's find out which one deserves a spot in your portfolio, and which ones you should probably avoid. So first, let's set the stage. What exactly are these funds trying to do? Covered call ETFs all run on the same basic playbook. You own a stock or a basket of stocks, and then you sell call options on them. Selling those calls brings in cash, premiums, which the fund then hands back to you as distributions. It's basically like renting out the upside potential of your stocks to someone else. You get income now, but you give away some of the future gains. That's the fundamental trade-off. Income today for growth tomorrow. Now let's start with the big one, JEPI. JEPI is like the rock star of the covered call ETF world. It's run by JP Morgan. It's tied to the S&P 500, and it's become one of the fastest growing ETFs in history. Why? Because it offers a relatively high yield, usually between 7 and 11%, but it spreads risk across the entire S&P 500. That's diversification. You're not tied to one company, you're tied to hundreds. And that matters, because if Apple crashes or Tesla implodes, you're not sunk. JEPI smooths things out. Plus, JP Morgan has the brand name and trust factor. For a lot of investors, that's worth something. Now compare that to QYLD. QYLD is the granddaddy of retail covered call funds. It tracks the NASDAQ 100, sells calls on the whole index, and hands out juicy monthly distributions. At one point, QYLD was paying double-digit yields, and dividend chasers couldn't get enough of it. But here's the rub. QYLD caps your upside so aggressively that over time the share price has been trending down. Yes, you get those monthly payouts, but your principal erodes in the background. It's like having a paycheck that looks fat, but your savings account keeps draining anyway. If you only look at the distributions, you feel rich. If you look at total return, the story is less pretty. And then we've got YieldMax. YieldMax is the flashy newcomer. Unlike JEPI or QYLD, which spread risk across dozens or hundreds of companies, YieldMax bets on one single stock at a time. Tesla, Nvidia, Amazon, Netflix. They take one stock, run the covered call strategy, and then slap a giant headline yield on it. TSLY, the Tesla YieldMax ETF, at one point boasted over 70% annualized yield. 70%. That number alone made people go crazy. It looked like a money machine. But when you dig deeper, you realize the same issues are there, and in some ways worse. Because now you're not diversified at all. You're all in on a single company, but without the uncapped upside. If that company tanks, you tank with it. If it soars, you miss out. So let's pit them head-to-head. JEPI versus QYLD versus YieldMax. First category, yield. JEPI typically pays in the 7 to 11% range. Solid, sustainable, not insane. QYLD has ranged between 10 and 12%, sometimes more, but often at the cost of losing share value. YieldMax? They throw out the biggest numbers of all, 30, 40, 50, even 70% annualized at times. On the surface, YieldMax crushes the competition. But here's the catch. Those yields are a function of volatility. If the underlying stock is crazy volatile, the option premiums are huge, so the payouts look massive. But that's not free money. It's risk disguised as yield. So yes, YieldMax wins the headline, but it's fool's gold unless you understand the trade-off. Second category, diversification. JEPI owns the S&P 500. QYLD owns the NASDAQ 100. YieldMax owns one stock at a time. It's not even close. JEPI and QYLD spread the risk across dozens of names. YieldMax leaves you tied to the fate of a single company. Diversification crown goes to JEPI. Third category, total return. This is where most investors get tricked. Distributions look nice, but what about the actual performance of the fund over time? JEPI has held up fairly well because the S&P 500 tends to grind upward over time. QYLD? Its chart looks ugly. It pays you while it slowly bleeds value. Total return has often lagged the broader market by a wide margin. YieldMax? Too new to have long-term data, but early signs show the same danger. Payouts that look amazing, but share prices that drift down. If your account balance shrinks while you collect big checks, are you really winning? That's the real question. Fourth category, risk. JEPI has broad diversification, active management, and a relatively modest yield. It's lower risk compared to the others. QYLD, higher risk because it's tied to the NASDAQ 100, which is more volatile. YieldMax? That's the riskiest of all. Single stock exposure, capped upside, huge volatility dependence. It's like eating financial ghost peppers. Not everyone can handle it. Fifth category, psychology. This one matters more than people think. JEPI attracts investors who want income but also some safety. QYLD attracts dividend chasers who love seeing monthly cash even if their principal slips away. YieldMax attracts gamblers. People who want to feel like they're pulling cash out of the market like a slot machine. And psychology matters because it determines how long you'll actually hold the investment. If you buy YieldMax for the yield and the price falls 40%, will you stay calm? Probably not. Now let's do some simple math examples to make this real. Say you put $10,000 into JEPI. At a 9% yield, you're pulling in about $900 a year. The share price moves roughly with the S&P 500, minus a little upside because of the calls. Over 10 years, you might not beat the S&P, but you'll likely be in positive territory with steady income. Not bad. Put that same $10,000 into QYLD. Maybe you get $100 a year in distributions. But history shows your principal could slowly erode. Over 10 years, you might end up with, say, $6,000 or $7,000 of principal left, plus the income you collected along the way. It feels good monthly, but long-term growth is weak. Now put $10,000 into TSLY, the Tesla YieldMax ETF. Say you hit one of those insane years where the yield runs 50%. You get $5,000 back in payouts. Feels amazing. But Tesla has a bad year and the ETF price drops 40%. Your $10,000 is now $6,000. Add back the $5,000 in payouts and you're at $11,000 total. You're technically up, but look what you gave up. If Tesla had just rallied 30% that year, a normal shareholder would be sitting at $13,000. That's the invisible cost of YieldMax. You don't feel it, but you paid it in missed opportunity. So what's the verdict? JEPI is the most balanced, the safest bet of the three. It's not perfect, but it offers steady yield with broad diversification. QYLD is okay if you love income and don't mind a shrinking principal, but it's a hard sell if you care about total return. YieldMax? That's for gamblers only. It looks sexy, it feels good, but it's dangerous. If you treat it as financial dessert, fine. If you treat it as your main diet, you're going to regret it. And here's the bigger truth. All of these funds prove the same thing. There's no free lunch in investing. Every yield comes with a trade-off. JEPI trades a little growth for income. QYLD trades a lot of growth for income. YieldMax trades nearly all the growth and diversification for the biggest possible yield right now. Different flavors, same rule, nothing is free. So where does that leave you, the investor? If your goal is long-term wealth building, none of these should be your core portfolio. The S&P 500, broad index funds, even dividend growth stocks, those should be your foundation. JEPI could be a side dish, adding income without blowing up your plan. QYLD might work for retirees who value monthly cash over long-term growth. YieldMax? Maybe a very small slice if you really want to swing for the fences with income. But understand the trade-offs before you buy. Because Wall Street is counting on you not understanding them. That's why they market these funds with giant yield numbers and splashy ads. They know most people will chase the number without asking the hard questions. But you're smarter than that. So here's the bottom line. JEPI is the safest of the three, QYLD is a mixed bag, and YieldMax is financial junk food. Tasty in the short term, dangerous in the long run. Treat them accordingly. And now I'll throw it back to you. Which of these would you actually buy? Do you own JEPI, QYLD, or YieldMax? Do you think the income is worth the risk? Drop your thoughts in the comments. And if this breakdown helped you cut through the hype, smash that like button and subscribe for more skeptical takes on investing. Because Wall Street loves to dangle shiny numbers, but it's up to us to decode what they really mean. Until next time, invest smart and stay skeptical.